Hello, and welcome back to the show. Today, we're diving into a topic that's been popping up a lot lately in real estate circles, especially among new or cautious investors. I'm talking about those incredibly cheap, tiny apartments near universities, advertised with eye-watering rental returns of 8%, 9%, even 10%. You've probably seen the ads. Full price only $200,000. Rental yield up to 10%. No hassle, fully managed. Sounds amazing, right? Almost too good to be true. Well, as the old saying goes, if it seems too good to be true, it probably is. But that doesn't mean there isn't a place for this kind of investment. The question is, whose place is it? Who actually benefits from buying a student apartment? And who should run the other way? In this episode, we'll break down exactly what student apartments are, why they're so cheap, what the real numbers look like behind those glossy ads, and, most importantly, whether you should even consider buying one. Let's get into it. Part 1. What exactly are we talking about? First, let's define what a student apartment really means in this context. We're not talking about buying a normal apartment and renting it out to students. That's a different strategy entirely. Here, we mean purpose-built student accommodation, usually a small, self-contained studio in a dedicated building near a university campus. These are often managed by a specialized company, sometimes in partnership with the university itself. The units are tiny, sometimes as small as 15 to 20 square meters. Think smaller than a hotel room. You got a single bed, a small desk, a bathroom, maybe a mini fridge and microwave, but don't expect a full kitchen. It's essentially a dorm-style living space, but privately owned. And the price? Well, that's the hook. You might see listings for as low as $150,000 to $200,000. In today's market, that's almost unheard of for anything within walking distance of a university. So why are they so cheap? Part 2. The illusion of cheapness. On the surface, $200,000 for a property near a university sounds like a steal. But let's do the math on a per square meter basis. If you're paying $200,000 for 20 square meters, that's $10,000 per square meter, which in many areas is actually more expensive than a standard apartment. So it's not really cheap in terms of value, it's just small. And because it's small, with no land component and limited functionality, the total price stays low. But here's the bigger issue. The buyer pool for these properties is very narrow. Most people buying these are investors, not owner-occupiers. And investors are a tough crowd. They're looking at numbers, not emotion. That means when it's time to sell, you're marketing to a small, analytical group of people who won't overpay. That alone should tell you something about the long-term resale potential. Part 3. The allure, why people are tempted. Let's be honest, the advertised rental yields are sexy. 7%, 8%, 9%, compared to the 3% to 4% you might get from a standard residential property. That's hard to ignore. For someone with limited cash, the idea of owning a property outright, no mortgage, and pulling in steady rental income is incredibly appealing. Plus, there's the perceived stability. Universities aren't going anywhere. There will always be students, especially international students, who often prefer these managed accommodations when they first arrive. Parents of overseas students are also more likely to pay rent up front 3, 6, sometimes 12 months in advance. That means less worry about missed payments. And because these are often managed by a central operator, you don't have to deal with day-to-day tenant issues. It's meant to be passive income. So what's the catch? Part 4. The hidden costs with a high yield disappears. This is where we peel back the curtain. That 8% to 10% yield you see advertised is almost always a gross yield. It doesn't account for high strata fees, because these are apartment-style buildings with shared facilities, common rooms, laundry, security, reception. The strata or body corporate fees are steep. And since the purchase price is low, these fees eat up a much larger percentage of your return. On a $200,000 property, a $4,000 annual strata fee is 2% of your asset value gone before you even start. Management fees. The company that manages the building and finds tenants takes a cut, often higher than standard property management rates. Higher maintenance costs. Student tenants are often living away from home for the first time. Wear and tear tends to be higher. Turnover is frequent. Most students stay only a year or two before moving into shared housing. Every time a tenant moves out, there's cleaning, repainting, and potential repairs. Vacancy periods, students leave during holidays. Summer, winter breaks, trips back home, it's not uncommon to have 1 or 2 months of vacancy per year. That 52-week rent assumption is often unrealistic. When you factor all of this in, that shiny 9% yield can quickly shrink to 4% to 5% net. Suddenly, it doesn't look so different from a standard rental property. Part 5. The capital growth problem or lack thereof. Here's the real deal breaker for most investors. Student apartments have notoriously poor capital growth. While a well-located house or standard apartment might appreciate 5 to 8% per year on average, student accommodation often lags at 1 to 2%, if it grows at all. Why? Because there's almost no owner-occupier demand. The only people buying these are investors, and investors buy based on yield. If the yield drops because the price goes up, demand dries up. Banks also know this. Try getting a loan for a student apartment. Most lenders will either refuse or offer very conservative terms. Why? Because if you default, they'll have a hard time selling it. That's a huge red flag. If the banks won't touch it, you should think twice. Part 6. The liquidity lock. Let's say you do buy one, and somehow it appreciates a bit. You made a paper profit. Great. But how do you access that money? With a standard property, you could refinance and pull equity out to reinvest. With a student apartment, refinancing is much harder, if not impossible. You're locked in until you sell. And selling isn't quick. The pool of buyers is small, and they're picky. While a normal home might sell in 30 to 90 days, a student apartment could sit on the market for months. So you've got an asset that's hard to leverage, hard to sell, and hard to grow. That's what we call dead equity. Part 7. Who should actually buy one? Now, I'm not saying no one should buy these. There's a niche. I recently spoke to a gentleman in his early 60s, semi-retired, with 2 investment properties already. He had cash sitting in the bank, and he wanted steady, low-hassle income, not growth. For him, a student apartment yielding even 5% net was better than term deposit rates. He didn't need liquidity. He didn't need growth. He just wanted the eggs, not the chicken. If you're in that position, retired or financially stable with a fully grown portfolio, and you're looking for supplemental income without risk or effort, this could work. But for most people, especially those still building wealth, this is a distracting detour. Part 8. Better alternatives for cash flow. If you have $200,000 to invest and want better cash flow, there are smarter options. Add a granny flat to an existing property. Invest in a dual income property, like a duplex. Look for residential properties in high rental demand areas that still have growth potential. Even consider REITs or dividend stocks if you truly want hands-off income. The goal in wealth building is to control appreciating assets. A $700,000 property with 4% yield and 6% growth will outperform a $200,000 property with 8% yield and 1% growth over time, both in cash flow and in net worth. Part 9. Final thoughts, the big picture. Student apartments are not a scam. They are a legitimate product, but they're a niche product. They're designed for a specific investor profile. One that prioritizes income over growth, has no need for leverage, and doesn't plan to sell. For everyone else, they're a tempting trap. The high advertised yields are a magnet, but once you look closely, the numbers often don't stack up. Always remember, in investing, if something looks too good to be true, it usually is. Do your due diligence, run the real numbers, and ask yourself, not just can I buy this, but should I? Thanks for joining me today. If you found this episode helpful, share it with someone who might be considering an investment like this. See you next time.